Good morning and welcome to the weekly roundup for the week ending Friday the 24th of September. As always, we hope you're enjoying these weekly reports, so please don't forget to subscribe and to receive our regular reports and stock market content. Also, just a reminder about the Atlantic Capital Markets app that you can download onto your phones. Now, this app gives you a whole host of useful functionality, including lots of things to help with your trades, plus of course our guidance for the week ahead, and the latest news as it happens. So if you head over to the App Store and get it downloaded straight after the video. But in the meantime, any questions, please pop them in the comments section below. We would love to hear from you. Let us know the sort of things that you'd like to be hearing in these regular reports. Finally, we invite you to follow our free stock market reports on tech stocks, banking stocks and IPOs using the link in the descriptions below. Well, this week has been a week of two halves. Central banks and Evergrande developments have dominated. Well, the week set off on the wrong foot on Monday with steep declines seen across the board amidst growing concerns over the survival of Evergrande, China's second largest real estate developer. Rumours swirled that Evergrande would default on its coupon payment on Thursday, and fear of this turning into China's layman's moment and concerns of contagion across the sector, or possibly across the wider financial system, sent stocks tanking lower. Indices across the board slumped to two-month lows, with the likes of the Dow Jones and the S&P taking out key support levels. The mood in the market improved towards the end of the week as Evergrande fears calmed, and after the Federal Reserve announcement. And as expected, the Fed left monetary policy unchanged. The US Central Bank also decided against announcing the start of asset purchase tapering. Instead, the Fed said that the time was approaching when tapering purchases could be warranted. In other words, the Fed hinted that a formal announcement for tapering could be made towards the end of the year, most likely in the November meeting. The push out of tapering asset purchases sent stocks surging higher, retaking some of the key levels broken earlier in the week. In the US, the S&P is set to gain 1% across the week, the Dow Jones 1% and the Nasdaq 0.3%. In Europe, the added uncertainty surrounding the European energy crisis didn't hold back the DAX, which powered 1% higher this week. Meanwhile, in Europe, the FTSE has been a notable outperformer, surging over 1.6% thanks to a boost from travel and tourism stocks, as the US announced it would accept fully vaccinated travellers from the UK and Europe. The BOE actually hampered the FTSE on Thursday. The British Central Bank, as expected, kept monetary policy unchanged. Policymakers at the bank voted 7-2 in favour of keeping the QE programme unchanged, and this was a slightly more hawkish vote than last month's 8-1. The prospect of monetary policy tightening unnerved the stock market, although it did lift the pound. In the exchange markets this week, the US dollar is set to end the week down 0.2%. Whilst the greenback found support from safe haven flows at the start of the week, the dollar declined following that Fed meeting. The pound is set to end the week flat. A strong bounce on Thursday following the Bank of England rate announcement helped the pound claw back losses from earlier in the week. And meanwhile, the euro is set to gain 0.2% this week against the dollar, which is more of a US dollar weakness story rather than due to any notable change in the euro's fundamental picture. In the commodities market this week, oil is heading for yet another week of gains. The black stuff is set to end the week 1.7% higher, which would mark its fifth consecutive winning week. Oil prices are being supported by tight supply in the US. The slow return of production following those recent US hurricanes has resulted in larger than expected draws in inventories. US crude oil stockpiles are at the lowest level since late 2018. On the other hand, gold prices extended losses again this week. The precious metal trades down 0.3% after falling 4% across the two previous weeks. The risk-on mood across the latter part of the week has dragged on gold. Furthermore, gold traders appear to have focused on the Fed's dot plot, which saw more Fed policymakers forecast an interest rate rise next year. And of course, higher interest rates are bad news for non-yielding gold. In the stock markets this week, British Airways owner IAG surged 15% after the US announced that it would allow fully vaccinated tourists from Europe and the UK into the US. The reopening of the lucrative transatlantic route is an important milestone for IAG's recovery. The announcement came hot on the heels of the UK's shake-up of its COVID travel rules, which should encourage more international travel from October. And another big mover this week is the oil giant BP. Now, BP rose almost 5% on the back of oil price rises, but also on the news that BP agreed to sell its Permian Basin assets to ConocoPhillips for $9.5 billion in cash. And this marks an interesting exit from its largest oil field in the US and does mark a major shift in its focus towards clean energy. And finally, over in the US, FedEx saw large moves this week. Now, the US delivery firm, often referred to as a bellwether, shed over 10% over the week. FedEx missed expectations in its quarterly results, reporting earnings per share of $4.37, and that was 54 cents below estimates. Whilst revenues of $22 billion was in line with forecasts, rising costs owing to limited labour supply, increased wages and higher fuel costs hit those profits. So that is it for the week. As always, thanks very much for watching. Please don't forget to subscribe. Don't forget that app. Get it downloaded right now. And of course, if you have any questions, just pop them in the comments section below. In the meantime, from all of us here at Atlantic Capital Markets, have yourself a great weekend.